Hello, folks. Brandon Chapman with you. It's another edition of the TheoTrade video for Monday, March 21st, 2022. And boy, kind of a crazy day in the market. I mean, in the end, did we do anything? No. I mean, we look at the after hours change here. We're minimally and for the most part, minimally down from last week. You look at the SPY, you get kind of the sense of where we're on a close-to-close basis. But anyway, not a lot happening. The range smaller than where it's been over the last 4 days. And yet so much happened today that really made it a significant day for the broader market. And I'm going to bring up the S&P 100 stocks up here so you can kind of see the top performing companies for the day and the lower performing companies. But you'll notice as you look through the list, top performing sector day, energy, followed by materials. You look at the top performing companies, Exxon, for example, Lockheed Martin, which is, of course, defense companies, ConocoPhillips, we got some Colgate Palmolive in there, General Dynamics, and so forth. But you'll see a lot of energy and materials companies, commodity type companies here in that list as well. And so when you look at it, you're like, wow, you know what? I mean, the Hawkish Fed today, Powell in his Q&A discussed the possibility of raising by 50 basis points in one of the meeting, addressed the potential for more aggressive quantitative tightening. If you don't know what that is, that means reducing the size of their balance sheet. Well, how do you do that when the Fed has been buying some longer-term treasuries as well that may not expire for 10, 20, 30 years? Well, you got to sell it. They own mortgage bonds. What are they going to do with those? Sell them? How are they going to tighten this thing in? It used to be in the past, prior to 2008, the Fed only bought T-bills. As a function, they could easily kind of walk away, let the balance sheet through attrition as the bonds mature and they get paid that cash back from the federal government. They would allow it to just evaporate and would reduce the monetary stock or the money supply. Now it's much more difficult. We engaged in Operation Twist in 2012, 13, and 14, moving out to the longer end of the curve, trying to signal to the market we're going to keep rates low for long. Well, we've been stuck in neutral now for over 10 years for all intents and purposes. In fact, if you look at IRX, you'll get a sense of historically what the Fed has done in terms of the Fed funds rate. We could go back 20 years and on a monthly basis and look at this, and you'll see that as this rises, the Fed is raising rates. As it falls, they're cutting rates. Why? The Fed has the most impact on short-term treasury bonds, in this case, 3-month T-bills. So you'll notice back here, for example, 2008, we went to ZIRP, 0 to 0.25%, stayed there until late 2015. We ratcheted up over a couple years to 2.5%, and then boom, had to go right back to the well of ZIRP again. And we just crawled out of the cellar now at 50 basis points on the Fed fund, the 3-month T-bill, but the Fed funds rate is 0.25 to 0.5%. Now, again, I mean, normally as the Fed begins to raise rates, it doesn't immediately affect the market negatively. But we've never been in this position where the Fed has to really strongly consider reducing their size of their balance sheet by selling treasuries and mortgage-backed securities. They've unwound their position, for example, in corporate credit, junk bonds, for example, and ETFs. But now, how are they going to unwind this close to $9 trillion balance sheet? It's going to be very, very difficult. This is a major, they've really painted themselves into the corner, and now we're wondering how they're going to get out of it without significantly affecting the economy. Remember, the Fed's policies are supposed to be virtuous. They can inject themselves, provide liquidity, and step away, and nobody's none the wiser. The reality is we know that that's not true, okay? And we're going to feel the impact. And right now, we're doing it with the backdrop of a global economy that is becoming increasingly isolationist, right? We're the Cold War. We're not exporting stuff. We're not producing stuff. We're finding our supply chain is compromised, and any attempt to move production home with our current regulatory environment and other factors, it's going to be expensive. So we're going to see high prices. So the Fed itself cannot really materially affect prices of anything unless they really hit the demand side of it. And the question is, are we going to see regulatory or policies put forward from Congress, maybe states, that may start to limit our ability to consume? Maybe that's travel, maybe that's food, whatever, right? As stuff becomes less and less available. Of course, Ukraine and Russia account for about 25% of the global wheat production. So again, we have this backdrop that we're dealing here with today, and yet the market takes what the Fed said and said, hey, And there was a couple others, Barkin. Gosh, what was the other one that spoke today? Bostich spoke today. And again, it's one of those things. They really kind of open the door to this concept. They may move more quickly. And how did stocks respond? By really doing not much of anything, right? We've opened and closed almost the exact same price from last Friday. Now, it didn't mean that everything was necessarily bullish. We can see that it was much more isolated in energy, whereas we saw technology, for example, communication, which includes stocks like Facebook, for example, and Google, and communications, ultimately did not really move higher at all. If we look at technology, right, XLK was down 0.19%. If we look at VZ, we're looking at a communications company, it was actually up. It does pay a dividend. It is near multi-year lows here. If we go back, going back several years, we're near lows and a high yield. And so again, it wasn't a bearish day, but energy and specifically oil stocks did well. If we look at energy and specifically oil, and I did a session for our TheoTrade members last Friday on understanding oil futures and other futures, understanding the term structure. So for example, if we go to product depth and you look at forward/CL, this contract's expiring here. So we've got May and so forth. Notice this is in what's called backwardation. And again, we've talked about this in this video before, that this is emblematic of what? A supply shortage. So the point being is that no matter what the Fed does, they can't engineer or pump more oil. It's going to require increase in domestic production. We're not seeing that right now. We're still below 12 million barrels, which is over 4 million barrels less than where we peaked several years ago. So we're stuck right now, right, with low oil supplies. A global environment of supply of oil is compromised. We're not taking Russian oil potentially. And who knows, right? We may further see kind of this isolationist policy, right? Well, if we look at this, oil was 7.5% higher today. Recognize this, that the oil risk is still to the upside. We drifted from 130 to 95. That might be a relatively small retracement. We didn't give back all of our advances since mid-February on that massive pullback. Could we see $200 oil? Absolutely, it's a possibility. Do we want to see it? Absolutely not. Had to drive a little bit over the weekend. Did not like the amount of cost associated with driving with our current gas prices. I know where you live regionally can impact that a lot. But today we did see a lot of bullish activity, option activity in energy. So for example, XLE on the June 85, right? So kind of scroll out here, out of the money, June 85, all the way here. That wasn't right. Sorry, I was looking at the wrong one. Might have been this right here. Sorry, but I didn't look at this one. I saw the significant activity here, and I should have looked at it a little more closely, and I didn't. So let's go down and look at it really quick down here. Option time and sales, and which you'll see 1319 right here. We have 80 calls being bought. Close to 6,000 contracts, over 6,000 contracts, 7,000, almost 8,000 contracts, and that's for a 17 June, and the 80 strike right here, for example, right? So we're seeing a lot of buying occurring here at the 80, and maybe just kind of a roll down from the 85. Didn't have a chance to look at it more closely here. But again, XLE pointing to an 80 strike here. If we look at NOG is one that, so I have a search that I do. In fact, in my class I was showing my session, showing this search here, the ability to isolate some significant option activity. But Northern Oil and Gas was one of those stocks. It was another one. It was a May 29 expiration, right? An upside call spread, buying the 29, selling the 34. This was a roll from the April expiration. So again, we're taking some profits, but rolling out and up to 34, right? And then as you look across the spectrum here, 34 is way the heck up here. We're still pointing to that possibility of significant upside risk. You look at Oxy, for example. Oxy was up almost 8% today. Of course, this is one in this video we've talked on Mondays. We've talked about bullish option interest in Oxy in the past. It's continuing today, for example. We look at April, scroll down. There's a lot actually in here. The 62 strike, for example, probably a little bit of rolling going on here, among other things. out here at the 75. Again, I mean, you see just renewed interest in energy. Shell today. There was a bearish trade on DBC placed later in the session, but this is July. Let's look at the July expiration. So if we look at today's option statistics, you'll see the puts were sizzling at 16 times the average, split pretty evenly here for the most part. We come out to option time and sales, and you'll see not a lot of significant like one single print. All my filters are cleared here, but when you look at the July expiration, where you did see kind of a cluster of activities right here at the 24 strike, which was leaning, it looked like more option buying for the 24. You'll see kind of a mixed bag in here, that 15 July 24 strike. But some of these were placed at the exact same time or similar time frame, and some reflecting the ask, some reflecting at the bid, and yet it was filled at the same price. And so as you look at this, again, probably more buying activity on the put side. So again, it's not exactly all honky-dory, but the risk right now for energy specifically is the upside. DBC has a more of a weighting towards that. Now, when we think about oil prices and we think about rising oil prices, we tend to think about inflation. And inflation's an issue, and this is obviously pressuring the federal government. In part, it's pressuring the Federal Reserve to potentially engage in policy that's more aggressive. And obviously, if we're going to potentially raise 50 basis points, or if we're going to engage in quantitative tightening, this would generally be very, very strong for the dollar. So if we look at UP as an example, UP was up marginally today. Again, this is 57% weighted to the euro/US dollar. It was down minimally as well. So very little intrinsic strength in the dollar on the part following the Fed policy. In fact, if we look at GLD today, or GC, whichever you want to look at, GLD was up a little bit, which would suggest the dollar was down slightly. If we look at Barrick Gold, the second largest gold producer, I believe, globally, it was up, today. And we did see some bullish activity on the 25 March. Now it's a weekly option. It's out of the money, or slightly out of the money at the 25 strike. Again, sometimes this gets faded a little bit. These are stocks to watch this week. There's a lot of activity kicking it off. And again, so we dovetail inflation, and today's comments did very, very little on inflation, but they did a lot in terms of the bond market. So for example, we look at the 10-year Treasury yield. It was up 7%, went from closing on Friday at 21.5 to finishing today at 23.15. We look at FVX. FVX was up 1.97. TYX was up 1.16. So what you may notice, the 30-year was up less than the 10-year, which was less than the 5-year. And something you may have noticed as we looked at the yields, so 23.15, just move that over a decimal. We're talking 2.315. And then you look at FVX, we're at 2.34. What happened today, and in fact, if I just do this, TNX minus FVX, you'll notice this actually finished in negative territory today at minus 0.25. What does that mean? It means the 5-year now is trading on a closing basis higher than the 10-year. Okay, we have now attained an inverted yield curve. And this is happening as we're seeing 40-year highs in inflation. And inflation is as far as the eye can see. But remember, we've talked about this before, the two competing interests here, right? Prices being a result of supply chain issues, the lack of production globally, and trade. And the second part of it, asset prices. What the Fed is about to engage in is going to disproportionately affect asset prices. And specifically, we're talking bonds. If we go and we take a look at HYG, the spread of high yield credit over treasuries is very narrow. We had a nice little bounce back or snap back in HYG. There was significant option activity back here on the 14th, which I believe I talked about in my last Monday video. In fact, we got a very, very nice snapback. Now we're seeing HYG roll over with the sell-off in treasuries. Now, while the sell-off in the 30-year treasury yield may be relatively limited, if you look at TLT as an ETF and a proxy of the price, HYG is in a different position. It is more affected by deflationary forces and more affected by the change in the credit quality environment. So why would I say this should be hit because of deflation? what we're experiencing right now, there's the chance, right, that we don't see the prices be affected. So the CPI may remain high. Meanwhile, what we're seeing right now is deflationary forces at work. HYG is not performing well. And in fact, even if you look at TIP has been taking it on the nose over the last couple of weeks as well with the sell-off in Treasury bonds. So we go back to HYG today. Let's look at the trade tab here. We're going to go to the April expiration. And you look down here. And again, this is a very, very actively traded product, right? But you'll notice right here, the 80-50 strike, 10,000 contracts against no or zero open interest. These were new strikes introduced here. And you're seeing that fill in. As you look at today's option statistics, it's hard to weigh 10,000 contracts. We're talking 270. But if we look at option time and sales, again, you can see some of this being injected in here. Trade Flash may give you an idea if you scroll through all this. But the point being is that it certainly looked like this was long put activity for that April strike at 80.50. Okay. And so again, I mean, we're seeing just a little bit of bearish activity come in today. And we're looking at downside here to 80. And that makes a lot of sense given the environment we're seeing of rising Treasury prices, expanding spreads between the risk of corporate credit versus treasuries and the risk between high yield or junk bonds and investment grade bonds. This could play out favorably in terms of the downside opportunity in HYG. And we may see ourselves break through that floor, right? And start to head back towards the lows. This was the COVID crash. This is where the Fed stepped in and began to buy. So we'll see this may continue to march lower over time. And we may eventually get to that level again when all is said and done as spreads start to widen out. Now, as we look at some of the other in the commodity space, for example, we looked at GLD, uranium. This is one I've been on for a couple of years now as opportunity. We saw the bullish activity come in on the 9th. It kind of dwindled here, came back in late last week. I talked about some of my sessions there. Bullish activity in companies like UEC, UUUU, 4Us, URA. Today, CCJ, for example, saw more bullish activity come in. This was the April expiration. Scroll out here to the 35 strike, mostly bought for April. A lot of it kind of middle of the day there as well. Upside activity, that's way out of the money there, right? Also on URA. Again, you'll see these things come up on searches, and you can search for it. It just takes a little bit more to then vet it to see, okay, what's there, right? And sometimes it's not the one that comes up on the search at times too. But if we look at URA, this was a weekly expiration. It was out of the money out here. 3,000 contracts, the March 28, 25 March 28 strike. Again, I mean, this can be faded, but, you know, again, we finished reasonably strong, but we close above this high. We may find ourselves in the coming weeks rolling back here. Again, this is just continued bullish option interest we've seen over the last couple of weeks in uranium. And again, the focus on the possibility of Russia announcing today they may restrict exports of uranium. That's a big deal. It's positive for the uranium market. And finally, we'll wrap this up with ag. And again, as you look at Mosaic here, Mosaic breaking out. This is one that, again, of the last number of weeks, focusing on agriculture, energy, and gold and silver, right? But again, today, so we had Mosaic was a weekly expiration. March 65, ended up gapping to it and trading through it. On the oil front, we'll look at a refiner, generally benefiting by lower oil prices. This is Marathon Petroleum Corporation as a refiner. Stock was up pretty nicely on Friday with good volume, kind of breaking out today on its way to a prior high. On MPC, it was the April, so we go to the April expiration. The 85 strikeout here, I believe there's one print for like close to 2,000 contracts. Again, looking for upside activity in refiners. And finally, I'll throw this one out. Utilities today were kind of interesting in that they did move higher, right? But they are an interest rate sensitive stock, and rising yields generally makes their dividend payments not quite as attractive. They have held up relatively well. They have benefited a little bit by the nuclear discussion, producing more power at cheaper prices. But do we really want cheaper prices right now? I'm not sure we have the appetite or the desire politically to really point towards lessening prices rather than causing prices to raise and feel the pain. But as we go to XLU, it was a April expiration, a 69 put. So watch here a little bit. There was some bearish activity coming into utilities today. And again, watch for it. Look for today's low possibly as a trigger, maybe even the low here at 69.50. This thing could see a reversal with the broader market. Again, right now from a VIX perspective, there's still maybe a little bit of upside here in good news. We're just not seeing that good news. And the risk, again, is to the downside until we start to see things turn. But again, the VIX is not as extreme as it could be. We're only down here at 23.5. The skew is rising right now at 136. So again, there's a little bit of risk to the downside here. We're seeing that tail risk come in with a higher skew. But there's still probably a little bit of room for the VIX to work its way down towards 20. Not sure we'll get there, but if we do, start to watch out. But today, the relative tenor of the market finishing flat on the session did not point to the potential negatives of higher rates and the bearish kind of hawkish projections that Powell and other Fed members were giving today. Anyway, that's where we'll wrap it up. We'll catch you back next week on the video. Have a great one. Thank you.